Ever feel like investing is way more complicated than it needs to be? Like every time a new strategy pops up on your feed, you're left with more questions than answers? One expert says to go all in on tech stocks, another swears by dividends, and suddenly you're staring at 14 tabs trying to figure out what makes sense. But here's a reality check. Most people don't struggle with investing because they lack information. They struggle because there's too much of it. Now imagine building a portfolio that not only holds up during market downturns, but also grows steadily over decades, all while investing less than the price of lunch each day. Think about that. $9 a day. That's what this strategy boils down to. And guess what? It only takes 4 ETFs. Just 4. With the right mix of these, it's possible to generate over $34,000 in annual dividends or grow a portfolio to nearly $1 million over 30 years. It's not magic. It's just a smarter, simpler way to invest. VTI, the foundation. Every great portfolio starts with a solid foundation. And when it comes to broad market exposure, the Vanguard Total Stock Market ETF, VTI, checks every box. VTI isn't just another fund. It offers ownership in over 3,600 U.S. companies, from massive tech giants like Apple and Microsoft to mid and small cap stocks scattered across every industry. It's like holding a slice of the entire American economy. What makes this so powerful? It removes the need to constantly pick winners. When tech stocks slow down, healthcare or financials can carry the weight. If large caps lose steam, small caps step in. This balance happens automatically, which means less time second-guessing and more time compounding. Over the past year, VTI returned around 11.27%, with a 5-year total return nearing 96% and over 154% in the last decade. That's serious long-term performance. And the cost? An ultra-low expense ratio of 0.03%, which means nearly every dollar invested works for you. As for dividends, VTI pays around 1.37% annually, and those payouts have been growing at a steady 6.73% rate. Not bad for a fund that's quietly working in the background, steadily building wealth. Over 30 years of investing $9 a day, the portfolio could grow to over $600,000. This is what makes VTI the anchor. It's broad, balanced, and built for the long haul. VO, the resilience layer. While a solid foundation keeps the structure standing, resilience adds strength when markets get shaky. That's where Vanguard's S&P 500 ETF VO steps in. VO focuses on America's 500 largest, most profitable companies, the ones that not only weather economic storms, but often come out stronger. These are the businesses that shape the economy: Apple, Microsoft, Nvidia, Amazon, Meta, and Berkshire Hathaway, just to name a few. These aren't risky moonshots. These are time-tested firms with serious staying power. And when markets dip, they often keep right on paying dividends, hiring staff, and pushing innovation forward. In the past year, VO delivered a return of 12.19%, with a 5-year return at 99.81% and a 10-year compounding gain of 168.52%. Like VTI, it comes with an ultra-low expense ratio of 0.03% and currently pays a 1.36% dividend yield. The annual share price appreciation sits around 10.32%, and the dividend growth is solid at 6.56% per year. Investing $9 daily into VO over 30 years could grow a portfolio to around $659,000, with more than $2,700 a year in dividends. VO adds resilience by narrowing the focus to big players, those with a track record of thriving through ups and downs. It's not about avoiding volatility, it's about leaning on businesses that survive it. IWF, the growth engine. Every balanced portfolio needs an engine, something that pushes it forward, even aggressively at times. Enter the iShares, Russell 1000 Growth ETF, IWF. This fund isn't for the faint of heart. It focuses entirely on high-growth U.S. companies, the ones innovating in AI, healthcare, cloud computing, and tech. Think Apple, Nvidia, Microsoft, Meta, Amazon, and Tesla. These names dominate IWF's top holdings, and more than half the fund is concentrated in its top 10. This isn't just about exposure to growth. It's about riding the wave of the future, investing in companies that are changing how the world operates, and the performance shows it. In the past year, IWF is up 15.75%. Over 5 years, it returned 122.14%. And across the last decade, a massive 273.68% in price appreciation alone. Dividends aren't the priority here, though it does pay a small 0.48% yield with a 3.21% dividend growth rate. But the average annual share price growth? A whopping 14.03%. Stick to that $9 a day strategy, and over 30 years, IWF could grow into a $1.2 million portfolio. Yes, it's that powerful. This ETF brings the speed. It's for long-term growth-minded investors who aren't chasing income now, but want serious appreciation down the line. It's not about short-term wins. It's about building wealth on a larger scale. Unlike broader funds, IWF deliberately filters out slower-growing value companies, zeroing in on firms with strong earnings momentum and reinvestment strategies. It's a focused bet on the companies driving tomorrow's economy. The sectors most heavily represented in IWF are technology, consumer discretionary, and healthcare, industries that tend to lead in both bull markets and innovation cycles. That makes this ETF inherently more volatile during downturns, but also more explosive during recoveries. It swings harder, but when it swings up, the gains can be dramatic. What sets IWF apart is its consistency. Despite market turbulence, it has delivered some of the highest long-term returns among large-cap growth ETFs. Because it's market cap weighted, the biggest players like Apple and Microsoft naturally dominate its allocation, which also reduces exposure to smaller, riskier names. It's not uncommon to see IWF bounce back faster than other ETFs after corrections, thanks to its exposure to companies with strong cash flows, global reach, and technological leadership. While the dividend yield is low, investors using this fund typically aren't relying on cash flow. They're banking on long-term capital growth. Over time, the reinvestment of even modest dividends combined with compounding capital appreciation builds a portfolio that's surprisingly powerful. It also works well when paired with more conservative ETFs, balancing out volatility with steadier performers like VO or VTI. Many investors use IWF as the growth core of their portfolio, while layering on income-producing funds to build a more flexible strategy. And because its holdings include several companies investing aggressively in artificial intelligence, semiconductors, and green tech, it has strong forward momentum. This ETF is often recommended for younger investors who have time on their side, allowing short-term volatility to work in their favor. It also aligns well with those who are comfortable letting investments sit untouched for long periods, allowing the compounding to do the heavy lifting. IWF's historical performance suggests that staying invested through the full market cycle is the key to unlocking its potential. Short-term news cycles or earnings misses might create temporary dips, but the long-term trajectory has been unmistakably upward. Even though it doesn't offer much income, it can be a great vehicle for eventually converting gains into dividend-paying assets down the road. The idea is to build the value now and harvest the income later, flipping the strategy as retirement or income needs approach. Adding IWF to a portfolio isn't just about growth. It's about owning a front-row seat to the evolution of the global economy. SCHD, the income powerhouse. Growth is exciting, but for many investors, income is just as important, especially as retirement approaches. That's where the Schwab U.S. Dividend Equity, ETFs SCHD, comes in. This ETF is built for one purpose: reliable, growing dividend income. And it does that without chasing risky high-yield traps. SCHD only includes companies with strong balance sheets, consistent earnings, and a history of rewarding shareholders. To make the cut, a company must have paid dividends for at least 10 consecutive years and meet several other strict quality metrics. This ensures only financially sound businesses make it in. Top holdings include Coca-Cola, Verizon, Lockheed Martin, Home Depot, and Amgen, companies that have proven their resilience across economic cycles. Over the past year, SCHD returned 1.18%, modest but typical in a flat market. Its 5-year return is 58.52%, and its 10-year return stands at 94.43%. The current dividend yield is 4.04%, with payouts averaging $14 per share annually. Even better, the 11.3% annual dividend growth rate over the past decade shows a strong commitment to increasing payouts. With that $9 a day strategy, SCHD could grow into a $1.69 million portfolio over 30 years, with annual dividends topping $200,000. That's more than $16,600 a month in passive income. This kind of steady income can offer a strong hedge against inflation too. As the cost of living rises, so does the stream of dividends, helping to maintain purchasing power without having to sell off assets. It's not the flashiest ETF, and it won't grab headlines like a high-flying growth fund. But for those who value income, reliability, and simplicity, SCHD quietly delivers. This ETF doesn't promise flashy returns. It's slow, steady, and laser-focused on building cash flow. And for anyone who wants real, spendable income later in life, it might be the most important piece of the puzzle. With all 4 ETFs in play, the next question becomes how to use them. Depending on financial goals, there are 2 simple portfolio strategies, one for income, the other for growth. The income portfolio leans heavily on SCHD, with 70% of the allocation. The remaining 30% is split equally between VTI, VO, and IWF at 10% each. This mix balances high dividend payouts with long-term growth potential. That heavy weighting toward SCHD isn't just for yield, it's for consistency. The strict quality screening that SCHD applies means the portfolio is filled with companies that aren't just paying dividends but are committed to increasing them steadily over time. Using weighted averages, the expected dividend yield of this portfolio is around 3.15%, with dividend growth at 9.56% annually. Stick to $9 a day, and after 30 years, the portfolio would be worth around $826,000. This setup is ideal for those looking to retire early or create a reliable stream of passive income that can supplement other retirement sources like Social Security or pensions. On the other hand, the growth portfolio flips that script. Here, 70% goes into IWF, with the rest split evenly among the other 3 ETFs. This strategy is focused on capital appreciation, not income. IWF's aggressive tilt toward tech and innovation gives it the power to outpace other ETFs in terms of raw returns, especially over long horizons. With this setup, the dividend yield drops to around 1.02%, but the average annual price appreciation rises to about 12.51%. That same $9 daily investment over 30 years could result in a portfolio worth around $927,000. This approach doesn't pay much along the way. Dividend income is lower, about $794 a year. But the end result is a snowball that can be tapped later for income or converted to dividend-paying assets. Too many people make investing harder than it needs to be. They chase hot tips, try to time the market, or pile into high-yield traps that collapse at the first sign of trouble. But with just 4 ETFs, VTI, VO, IWF, and SCHD, it's possible to cover every core need: foundation, resilience, growth, and income. This strategy isn't about finding the next big stock. It's about balance, simplicity, and consistency. Whether the goal is long-term income or long-term growth, these ETFs can be combined to match the strategy. No guesswork, no stress, and the best part? It only takes $9 a day to start. If this helped bring clarity to your investing journey, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss the next strategy breakdown.